All right, let's talk about something that pretty much turns basic economics upside down: negative interest rates. It's one of those ideas that seemed completely out there just a few years ago, but now it's a reality for some of the world's biggest economies. So, how in the world did we get here? And what does it even mean when you have to pay to save your own money?
Seriously, just think about that for a second. Instead of your savings account earning a little bit of interest, the bank actually charges you a fee just to keep your money there. It sounds totally backward, right? Well, this strange counterintuitive idea is exactly what negative interest rate policy is all about. So, to really get our heads around this strange new world, we've got to first break down what a negative interest rate actually is and why it's not just some wild theory in an economics textbook anymore.
Okay, so at its core, this is a tool that central banks use. The logic goes something like this. They charge commercial banks, the big banks, a fee for just parking their cash. The whole point? To give them a little nudge or a big shove to lend that money out to businesses and to people like us, instead of just sitting on it. The theory is that more lending and spending should, help fire up a sluggish economy. Now, while negative rates feel like this crazy, radical, modern invention, get this. They're actually the final stop on a journey that's been happening for centuries. I mean, look at this chart. Real interest rates, that's the rate you get after you account for inflation, have been slowly but surely falling for over 700 years. The road to zero and then below zero has been a long, long time in the making.
And again, this is not just some abstract idea. A bunch of major central banks have already gone there. We're talking about the European Central Bank, the Bank of Japan, and the national banks of Switzerland, Denmark, and Sweden. They've all jumped into negative interest rates, trying to jolt their economies back to life. Which, of course, brings us to the really big question. Why? Why are central banks turning to such unconventional, you might even say desperate, measures? Well, the answer really lies in the massive crises that have shaken the global economy.
This quote right here, it really nails it. See, after the 2008 financial crisis, central banks used their standard play. They cut interest rates, but they pretty quickly hit zero. So when the next crisis rolled around, they had to get creative. And suddenly, all those unconventional policies from yesterday became the standard tools for today. And this slide just shows you how much things have escalated. On one side, you've got the 2008 crisis, which was born inside the financial system. The response back then felt huge. But then, 2020 happened. The pandemic was an external shock that basically shut down the entire world. And this time, central banks acted with a speed and a scale that made their 2008 efforts look small. And just to give you a sense of that scale, in 2020, the U.S. Federal Reserve spun up lending facilities that could pump over $2.3 trillion into the economy. I mean, that is just a mind-boggling amount of money, all of it designed to keep the economy from completely collapsing. So the intervention was absolutely massive. But did this radical tool, these negative interest rates, actually work? Did it get the job done? Well, the evidence is surprisingly kind of murky. In places like Europe and Japan, it may have helped stop deflation, which is good, but it didn't exactly spark the huge lending boom that everyone was hoping for. And hey, you don't have to take my word for it. This is Jerome Powell, the head of the U.S. Federal Reserve, saying pretty bluntly that he's not sold on the idea. The fact that the world's most powerful central banker is giving it a thumbs down, well, that tells you just how much debate is still raging about whether this policy actually works. And that skepticism, it comes from some very real potential downsides. Negative rates just fundamentally warp the financial system. They mess with how lenders price risk, they could spook people into pulling all their money out of the banks, and they might even push people to just start hoarding physical cash under the mattress, which, of course, would completely defeat the whole purpose of the policy. All these unintended side effects really point to a much bigger, more profound idea. We're not just dealing with new tools in a toolbox. We are in a whole new era of risk, an era where one single problem can set off a dangerous, interconnected chain reaction. The COVID-19 pandemic is just the perfect, terrifying example. The speed of it was absolutely breathtaking. In just 2 months, we went from the first whispers of a new virus to a full-blown global pandemic that slammed the brakes on the entire world. And this right here is the critical part to understand about our world today. The pandemic started as what's called an operational risk, an outside event, but it didn't stop there. It instantly triggered market risk as stock markets around the world plunged. That led directly to credit risk, with everyone suddenly terrified that businesses would go bankrupt, which finally forced that massive policy response we've been talking about. It was like one domino knocking over the next and the next and the next. Okay, so in a world full of these cascading, unpredictable risks, how can anyone, from central banks to global companies, actually prepare for what's coming next? The old ways of planning just aren't going to cut it. This is where a method called scenario analysis comes into play. Now, the key here is that it's not about trying to predict the future with a crystal ball. Nobody can do that. Instead, it's about imagining several different futures, even the really extreme ones, and then working out how you'd respond to each. It's all about building resilience for when the unexpected happens. And by doing this, organizations can start to get ahead of the curve. They can spot new risks before they blow up in their face, they can stress test their plans against extreme events, and ultimately, they can protect themselves from getting wiped out by the next unthinkable crisis. It's really a big shift from just reacting to stuff to proactively preparing for it. And that really leaves us with the final huge question. We've seen a global pandemic shut down the world. We've seen once unthinkable negative interest rates become a reality. So in this new normal, where the economic playbook is constantly being torn up and rewritten, you just have to ask, what's the next impossible event that's going to become our reality tomorrow?